And I kind of view us as being in a lost decade where I just don't think the 2020s decade from the recent, peak in 2021, I don't think it's going to be looked back on as a very good decade, especially in inflation adjusted terms and probably not that great in nominal terms either.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with macro and market analyst Lyn Alden. If you haven't yet watched part 1 of our discussion with Lyn, in which she warns that once the debt ceiling is lifted, Janet Yellen will then need to replenish the U.S. Treasury general account, likely triggering a liquidity crunch, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Okay, let's get started watching part 2 of our interview with Lyn Alden.
There's a general consensus of the folks that I interview on this channel that earnings probably still need to come down. Earnings estimates still need to come down to map closer to reality. That speaks for sort of a broad base repricing in the markets here. What are you expecting?
I think basically flat to down in nominal terms and down in real terms is probably how I look at corporate earnings overall. Generally in inflationary periods, it's kind of hard to get a really deeply nominal decline just because the unit of account is changing so much. But you certainly can get, somewhat down nominally, which can be quite down in real terms. And so generally especially the large cap, just, basically like the big index is just, I think not a very attractive. And I kind of view us as being in a lost decade where I just don't think the 2020s decade from the recent, peak in 2021, I don't think it's going to be looked back on as a very good decade, especially in inflation adjusted terms and probably not that great in nominal terms either. And I think this year is kind of a microcosm of that, where I'm not necessarily expecting massive crashes unless officials try to cause like a absolutely severe liquidity crisis. But I'm also not expecting very bullishness action either. I think it'll be very sector specific. And I think a lot of things are just going to be grindy and sideways and choppy and volatile. And sideways can mean down 20%, up 20% in a given area.
Yeah.
And just, when you look back a year from now, 5 years from now, you're kind of like, what did we didn't really go anywhere.
So that echoes what a number of the experts I've had on this channel too have been saying, and really trying to underscore for folks. We've gotten so conditioned to the easy passive investing route because it's what worked, while we had kind of forever stimulus from the central banks and rock bottom interest rates, and a Fed put, where the Fed was willing to step in and help out wherever it could. And so they're saying, you really got to switch playbooks in this market to an active one for exactly the reasons that you just mentioned. You pick your head up in 5 years and find out indices really kind of went nowhere. And so it becomes much more of a stock picker's market where you really got to separate the wheat from the chaff. You just can't buy the ETFs and expect everything to go, all boats to rise together. So I assume you'd agree with that?
Yeah, we had 40 years of declining interest rates, which means, one, you got higher corporate profit margins, but then you also had higher valuations placed on those earnings. And so you had multiple tailwinds causing everything to go up together for like 40 years. And just going forward, I think some of those tailwinds are gone now. We don't really have the benefits of globalization we have over the past 30 years. We don't have the tailwind of ever lower interest rates. And so I think a lot of that is behind us. And now things are in a grindier environment, at least this decade. And that requires more careful sector analysis, more careful company analysis. It's also like when things are the top of the range, you can like sell covered calls to get extra income and extract kind of more value out of that position. When things have a big down move, you can maybe move, some of your T-bill position back into the market. There's different things you can do to kind of adjust to the ebbs and the flows. And there are sectors that, for example, on the opposite side of this bank problem, for example, like certain energy pipelines, right? What they, like energy product, for example, like EPD, what they did was Enterprise Products Partners, that's the right. So what they did was basically they borrowed an average rate of 20 years at a pretty low interest rate, and then they have all this, real asset exposure. And so they have, 25 years of distribution increases. They yield over 7%. They have all this low fixed rate debt. And so they're kind of sitting on the opposite side of what all these banks are dealing with, where they lent at long durations at low rates. So one thing to look for is what areas borrowed for long duration at low rates that are fixed and that have variable or real asset underpinnings. And so those are the ones that I think can grind out an advantage over this decade, where they're not reliant on interest rates coming down. They're not reliant on ever higher valuations. They're just operating profitable businesses with their debt denominated in like negative real rates and returning
They're in the
capital to
catbird seat
shareholders.
right now. Yeah.
Yeah. And so I think that there's, between covered calls, whatever tools that an investor's familiar with kind of grinding through a sideways decade I think is the type of action to be familiar with here.
All right, I'm really glad you mentioned both those strategies, and then you gave us a pearl of one particular company to look at here. But so we have the endorsed financial advisors on this channel, Lyn, that we have and talk about kind of the strategies like the ones you just mentioned. So I'll do this at the end of the video, but I always recommend that the average person who wants to take advantage of those types of strategies but doesn't have a lot of practice doing it, find an advisor who is well experienced in those, and who also understands and takes into account all the macro stuff that you were talking about in this interview, Lyn, because a lot of them don't, right? Sadly, a lot of what you've talked about here today goes over the head of a lot of general financial advisors out there. So you really want to find a good one. All right, well, look, beginning to wrap up here, but I've got a couple assets I want to ask you for your response to, but real quickly, are there any general asset classes that you think are either positioned particularly well right now or poorly right now for the kind of near to midterm outlook you see ahead? So yeah, over the 5 years or plus, you're going to have to be reacting in real time to the tea leaves. But as things look to you right now, like I assume, probably not a bad time to still be parked in quality bonds right now, particularly treasuries, just because things are a little bit murky and you're getting paid a good amount of money to be in safety where you weren't in the years prior.
Yeah, I think T-bills, money markets, those are some of the best low volatility defensive assets. I think gold is attractive here. It's possible that gold stagnates for a little bit because, there was a recent buying pressure into gold that might, settle out and normalize for a period of time. But I think that as the Fed kind of finishes their hawkish cycle, I think it's attractive for gold. Like I said, some of those income producing assets that have kind of low fixed rate debt are attractive. That's kind of the general approach here. I think I've been watching energy producers lately, energy and energy producers, because a lot of that was sold off sharply with the banking crisis. I think some of that's overdone to the downside.
Mm-hmm.
Now, I'm still hesitant to be super bullish on energy with a somewhat recessionary outlook. So I kind of caveat that with, I'm not saying we can't see lower, but I am both long-term bullish on some of those. And even in the intermediate sense, I think it's somewhat overdone to the downside. So I think it's worth shopping around or looking around in that space in the weeks and months ahead for, anything that crashes in that space could be a interesting purchase.
Okay, great. I think similar to you, and we're planning here on Wealthion is trying to bring some experts in on that space who can actually give a couple of stock recommendations to look at. And I should note, folks, that at the recent Wealthion online conference that we had a week ago, Rick Rule shared, I think, over 30 of the stocks that his most favorite stocks that are currently in his portfolio. And a good chunk of those were energy stocks. So if you want to go watch that, you can go purchase the replay videos at wealthion.com/conference. But I'll put up a link to that right here. All right, Lyn. So well, real quick on bonds, do you think we've seen the peak in yields?
I think, for example, the 2-year peak, there's a good chance that's in. There's certain tail risks that can happen with the longer duration assets. I mean, if the market especially the next inflation cycle, if the market perceives that the Fed's kind of given up on their inflation fight, and they expect longer inflation, like basically higher inflation for longer, some of those long duration yields could actually have an upward move. I don't really expect that right away, but it's something I'd be concerned about. I still think that long duration bonds are basically going to give you a lot of volatility without a lot of returns this decade.
Mhm.
And so, a trader can make use of them, but I'd be pretty careful with them. Again, I don't know if the Fed's going to try to push through another 25 basis point hike or not. I try not to be, too sure around what they're going to do on the margins, because it kind of comes down to one person's decision, and I haven't met the guy. So
Right.
I can only kind of look at what market's pricing. I can look at what some of the ramifications are if they try to keep raising. I also see disinflationary pressures in the intermediate term, which gives them, reason to remain tight to varying degrees, but not necessarily reasons to keep tightening. And so I think Powell's incentives are aligned with kind of a pause and see here.
Okay. All right. I agree with you, and I've opined on this channel that there's a risk, obviously, of the Fed over tightening, and we don't know if they may have already over tightened. We talked about that lag effect, right? And so for a while, I've been saying just a wait and see approach probably isn't bad, anyways, just to give those lag effects a chance to hit, and you can always tighten things back up if you need to. But anyways, I think you summarized it well. All right, so I'm wrapping things up here. Thank you for giving us so much time, Lyn. This is the unfair question, which is there anything in just a minute or two that you'd like to share about the current state of the crypto ecosystem? And I promise you, I can invite you back on again in the future if you want to be able to tell your full message on it at some point. I know it's a complicated, difficult topic to try to summarize in just a minute or two.
Sure, I view it as two very different ecosystems. There's kind of the Bitcoin ecosystem that I'm pretty bullish on long term. If you look at globally what's happening, Bitcoin and certain stable coins are often used as utility assets. I mean, if people in Nigeria, people in Lebanon, people in Argentina, a lot of people want these types of assets. And some of the development work that's happening on the Bitcoin stack, I think, is really interesting. And so, especially with the Fed, at least kind of near-term peak hawkishness kind of priced into the market. I wouldn't be surprised to see Bitcoin just chop along for a period of time. But I think a lot of the leverage has been washed out. A lot of the kind of the tourists are out of the space. And I'm kind of bullish on that space with a 3 to 5 year view. As for the kind of the rest of the crypto space, I just don't really touch it. I don't think it's, there's all sorts of regulatory uncertainties. Coins come and go. They all have their pump and dumps, their moment in the sun. A lot of them are centralized. The VCs actively promote them while using them to get out of their positions. We see increasing regulatory action. We just saw, for example, Binance under pressure legally. Really, that kind of whole casino crypto yield space is just not attractive to me. There's elements of innovation that are happening that I think, as things blow up, maybe that can be taken and put somewhere else. But really, that whole kind of playground of that crypto casino thing is just not an area that I really go into. I think Bitcoin is basically the signal in that space.
Okay, thank you very much. And the next time we have you on, Lyn, I promise I'll give you more time. We can go more deep into exactly why you're bullish for the long term on Bitcoin. All right. Well, look, I'm going to ask you my parting question, which is, where can folks go to learn more about you and your work? But before I let you answer that, there's a question I'm sure a lot of viewers have had during this interview, where you've got clock behind you, but it clearly isn't using the regular standard digits that we use to measure time conventionally. So what is that?
That's a block clock that displays. You can display all sorts of different information with it. That one actually shows the Bitcoin block height. So it basically shows the time chain adding new blocks over time, which I find unique. That it's from a company called CoinKite, and I know the founder of it, so he sent me that as like a, so I kind of keep it there to give him a shout out.
Cool. All right. Well, look, yeah. So we just gave him a little advertisement there. But that's
there was a funny meme where Jack Dorsey had one of those behind him, the founder of Twitter and Square, and he was giving an interview, and he had one of those behind him, and it showed, I think, how many. So a fraction of a Bitcoin is called a sat, and it showed how many sats were for the dollar. And at the time, it was something like 2,000, and people were trying to figure out what that number was. And someone was like, "Is it Moscow time? What number's there?" And so it kind of came like a meme in the space. But yeah, it's when you see kind of clocks like that, it's basically generally in the Bitcoin space. It's kind of like this way of displaying information.
All right. Well, I can't wait to see the first Lyn Alden meme from this video with the clock behind you and whatever it's reading in the screenshot that they use for the meme. Well, thanks for explaining that. It's really interesting. All right. So final question. Where can people who have really enjoyed this conversation, Lyn, maybe probably not too many people, but maybe getting exposure to you for the first time, where can they go to learn more about you and follow your work?
So lynalden.com. I have a bunch of public articles. I have a free newsletter, and then I also have a low-cost research service that people can check out, where I provide updates every 2 weeks on different markets, macro, specific investment opportunities like pipelines, or whatever's going on in different sectors.
Okay, great. And I know you're very active on Twitter as well.
Yeah, at Lyn Alden Contact on Twitter. I cover, I provide charts. I cover kind of just commentary what's going on. Sometimes I use it to generate ideas that I then write about in more detail in either my public or private writings.
All right. Well, Lyn, thank you so much. This has been a wonderful discussion, as it always is when you're on the program. I know your schedule is really busy these days. I really appreciate you making time available for us. You're welcome on this channel at any time, and look forward to having you back on maybe in a quarter or so, and you can give us an update on where things are based upon what's happening in the world then.
I appreciate that. Thank you for having me.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Wealthion. I'm joined here as usual by lead partners John Lodra and Mike Preston from New Harbor Financial. Hey guys, great to see you. Been seeing a lot of you guys lately, especially with the conference that we just did the other week. Lots to talk about here in the aftermath of Lyn's great conversation. She never disappoints, super sharp. I want to get through a couple of the points that she made here with you, but why don't we just start with you, John, with some of your key, what were your biggest takeaways from the conversation?
Yeah, hello, Adam. We really enjoyed Lyn's talk. She's always very chock full of data and perspective, and we really value that to check our own assumptions with some critical tire kicking. We can't seem to talk about anything these days in markets without, again, talking about Fed and Fed policy and some of the ramifications of that. Most recently, ripples through the banking system, which absolutely have at their genesis the easy money policies of the Fed these last decade. But Lyn talked about what we have come to all take as obvious, but there are important implications that we have transitioned from the easy declining interest rate environment of the last 40 years to a regime where the Fed has been forced to come off of low interest rates for obvious reasons, including inflation. But there are starting to be some cracks in the system, and some of the very foundations that have driven the last decade are really starting to take a sting. If you look at classically interest rate sensitive sectors like real estate, things like that, we're starting to see some real troubles start to express themselves there. Just looking at the near-term charts of, for example, REITs and home builders, for example, there's been some real dramatic pullbacks in there, and they're getting to a point where they could have some serious downside breaks. And those are the obvious sectors that people think about when interest rates increase sharply like they have over the last year. Interest rate sensitive industries, which are largely debt-laden industries. Real estate is very much a debt play, right? A leveraged debt play. But Lyn properly points out that things like technology, the technology sector, is also in a kind of indirect way very interest rate sensitive, because in the kind of environment we've seen over the last decade, basically the cost of capital becomes so low that the hurdle rate for growing companies, which classically is the tech sector, even without meaningful earnings or strong earnings, they're able to issue equity almost without restraint and raise capital, and that creates a self-fulfilling prophecy on rising stock valuations, even though the underlying metrics of revenue generation, things like that, are underwhelming. Let's put it that way. And that's actually a very profound conundrum in our minds right now. If you look at what the tech sector has done over the last several months, especially year to date, it's been quite a conundrum. It's been a very strong sector. We're trying not to read too much into that, other than it's a bit of a head scratcher. Perhaps it's foreseeing a loosening of monetary policy, but we think it's just probably more of a stampede into that sector more than a thoughtful, durable rotation to have a meaningfully continued bull market in that sector. But a bit of a head scratcher, I'll be honest. But yeah, the big takeaway is we're starting to see some real chinks in the armor here. The banking crisis that we're kind of still in the midst of is one very applied example of that obviously we think will have other tangential effects on markets and the economy. So that's kind of big picture takeaway to kick us off here.
Okay. Mike, I want to come to you. Just some key points that she made that I want to make sure we sort of squeeze in here. One of the big sort of warnings that Lyn raised is, look, we've markets are off their October lows, right? And they sort of continue to rally into the new year here. But if you look over the past month, the S&P really hasn't gone anywhere. And if you look at it from January 1st to now, it's up only marginally, about 100 points. So, she sort of talked about the potential of being in this. She was kind of talking with a 5-year outlook, but folks like John Hussman, have more like a 10 or 12-year outlook, where they say, we could be kind of looking at sort of this lost decade here, where, at the end of 5 years, the end of 10 years, we might say, what, the markets didn't really go anywhere in real terms, maybe even nominally. But of course, there's a lot of ping-ponging around, right? And so we're entering this era where the passive playbook that worked so well, in the past, it's probably not going to work in this type of environment. You need to be much more active going forward. And I know we've talked about this a lot on the channel, so feel free to add any commentary you want to that. But we've already sort of talked about that. But what I took from her warning was, look, there's been kind of a stealth stimulus going on right now with Janet Yellen issuing funds from the Treasury General account, because the U.S. is currently at its debt ceiling. She can't issue more treasuries, and so she's basically been pushing money out, paying the nation's bills by draining the Treasury account, and this is to the tunes of hundreds of billions of dollars. And that's partially likely why we found a bottom in October of last year, and the markets have been supported now. She's basically saying, look, at some point, with very high probability, we know that debt ceiling is going to get raised. And once it does, she's going to have to then revert and start trying to refill the TGA by issuing a lot of treasuries. And that is going to basically turn off, that stealth stimulus spigot and tighten things further in the economy. So I'm curious what you think that means from a market standpoint. But I would imagine, okay, that's one of the few pillars that's been propping prices up right now that looks like it's going to get removed soon, perhaps as soon as they reach a deal on the debt ceiling.
Yeah, let me respond to that and perhaps mention a few other points in my notes. I too enjoyed Lyn's talk. She really knows her stuff when it comes to the economy and the Fed, and I know she knows quite a bit about the crypto space as well. But just further to some details about this, as she talks about the economy being at stall speed, and anyone that's ever been a pilot or trained to be a pilot, that stall speed is a very critical phase where, the wings of an aircraft don't have enough air flowing over them to produce lift, and it creates a very kind of turbulent airflow. And the aircraft can critically stall and roll over, and it's a very dangerous situation. I thought that was a really good analogy. That's where we are right now, economically and in the market. If you look at the charts of the big indexes, they're also at pretty critical points and seem close to stall speed. So she says we're in the eye of the storm. and the Fed can't tighten later in the year, maybe they can tighten now. Although she said there's an 86% chance, or maybe you said it, Adam, 86% chance of no hike at the May 3rd meeting. So that wouldn't surprise me.
That's the current CME FedWatch tool. That's what it's predicting is 80. I don't have the number in front of me here, but it was something like 86% that the Fed is not going to hike at its May 3rd meeting.
So they're probably not going to hike. It seems like the market thinks that. Maybe they're done. Maybe it's a pseudo pivot. I think maybe Lyn used words like that. And they can't hike later in the year because the liquidity isn't there. And you just mentioned, Janet Yellen pulling back the notion of paying bills out of the Treasury. That's kind of a tightening too. So the truth is, technically speaking, the market's in a dangerous place. It is at stall speed. The economy's at stall speed. And Lyn talked about tailwinds that we've had for a few decades here: globalization, offshoring of jobs, ever lower interest rates over the last 40 years, and all of which called multiple expansion. And now you have all of these things in your face instead of a tailwind. Interest rates are going up. Globalization is namely or mostly over and reversing in some instances. And she talked about the era of easy passive index investing is probably over. Particularly at current valuations, the risk of downside air pockets are very high. This plays really well into the things that we care about and the things that we like to do, like covered calls. You can sell covered calls. It's still a bullish strategy, but with the belt and suspenders approach. You're trying to hit a lot of singles instead of home runs. Or moving to treasury bills, moving cash and or treasury bills out of cash and into the market at opportune times. So the words that she used in her prediction of what she thinks could happen in the market was sideways, grindy, choppy. Maybe. I still think there's a big downside elevator drop risk. It's kind of maddening and test your patience to watch the market here trading at the same level roughly that it was last May. So almost a full year, plus or minus a few hundred S&P points. And so the market has just really not made much downside progress, and it's been choppy all over the place. So the temptation is to think that it might continue that way, and it might. All of which is to say that a more active management style is probably what you want to do. If you want to be passive, I'd be passive in treasury bills, frankly. The 6-month treasury bill is roughly 4.5%. Reduce risk, get out of the market to a large extent, passively sit back in treasury bills, wait and see what happens. There's going to be plenty of opportunity later to be aggressive. So I'll stop there. She went into some specific recommendations, which I'm sure you'll give us opportunity to respond to in a minute. But overall, a really good talk.
All right, great. Yeah. So Lyn did, basically say, look, this is a time for safety, and that's echoing what many of our guests have been saying right now. Talked a lot about, staying in quality bonds and really at the shorter end of the duration spectrum, not taking too much risk by trying to play the long game, betting on a Fed pivot. But she did talk about this, look for companies, like prioritize companies if you're going to be long stocks that are income producing but have low debt costs. So she talked about one company, Enterprise Product Partners, that basically did a massive capital raise before this recent hike in rates. So they're kind of sitting on a big pile of very cheap cash, right? And they're profitable, they're cash flow positive. Basically they can continue to invest in their cash flow positive operations from this very cheap line of debt that they have, right? So that's kind of a good thing to look at, is who were companies that were smart or lucky enough to raise a big war chest prior to this increase in rates, and yet are cash flow positive. And so, they can be investing that cheap debt with a positive ROI. John, I know you're nodding as I'm saying this, so I'll give you a chance to respond to that in any way you like. Real quick, though, I do just want to combine Lyn's warning about the liquidity crunch that might result from the TGA having to replenish itself. One that's going to stop flooding money into the economy. It is likely to increase yields on treasuries because you are pushing a lot of extra treasuries into the market, and therefore competition for those goes down, and therefore yields must go up. So that is going to be further constrictive to economic growth. And I want to combine that with a warning here that was just issued by Jeff Gundlach. He is, highly respected capital manager. He says that he sees risk of an imminent recession within the next few months. He's lists a number of reasons for this, but one of the things he notes is that the yield curves, which have been, inverted, all year so far, many through 2022, are now starting to uninvert. And in fact, the 5-10s spread actually did fully uninvert last week. It's now inverted again, but not nearly where it was. So this is sort of what you guys and a lot of the people on the channel have been warning about, which is, when yield curves invert, that suggests that recession is going to happen at some point in the future. But once they've inverted and then they start to uninvert, that gives you a sense that, like, okay, the game is on, the fuse is lit, a recession's now, likely on its way, pretty soon at this point. So we are beginning to see that uninversion process in an increasing number of yield curves here. In addition to inverting yield curves, what Gundlach predicts here is that the Fed is going to pivot, and it's going to be cutting rates at least a couple of times this year. So, he sees recession, pivot, and here's his parting quote that I just want to get your reaction to, John. He says that the markets are becoming more volatile, especially the bond markets. And he says, the markets are so volatile, so much movement, that it's almost impossible to sell on weakness. The markets just go from a mine shaft type of decline. And that's true in the credit markets. And I think it's true in other risk assets as well. So, what he's basically saying here is there isn't going to be, in his mind, much of an opportunity to sell on weakness. Like, those people that are saying, oh, I'm going to dance close to the door, and then when things start to look a little rocky, then I'm just going to sashay outside the door and I'm going to be fine. He's basically saying we're highly likely to see the type of correction that just catches everybody overnight, like a mine shaft drop, right? Sort of similar to Lyn's points, he's encouraging, like, this is a time to be in safety. This is not a time to be picking up those nickels in front of the steamroller or taunting risk in any way by even remaining on the dance floor, no matter how close it is to the exit. So, John, curious to hear your reaction to all this.
Yeah, I'll try to answer those thoughts in reverse order, starting with the last one. Absolutely. If you look at the kinds of conditions that historically have been conducive to elevator drop types of declines, it's the kinds of things we see now. Extreme overvaluations in asset prices. U.S. stocks are still broadly very overpriced relative to history, even with last year's weakness in the stock market. We have a really dramatically changing monetary landscape, as well as a fiscal situation. We talked about I'll talk about the debt ceiling and implications there. Still a persistent inflation thing. So these are the kinds of, syndrome of or coincident realities that oftentimes in history anyways have given the open door for elevator drop types of declines. And exactly right. Those kinds of declines are the ones that people get trapped in because it comes quicker than they imagined. And then the psychology starts to work in reverse. If folks were inclined to get a little bit more conservative, their mind starts to say, well, I can't sell now because things drop too far too fast. I'm going to wait for it to bounce a little bit to kind of get back to at least recover some of my quote unquote losses that I incurred for not selling when I thought I should. And the problem with that is oftentimes when there is that sea change of a kind of environment, you never get that balance, or at least not the balance that you mentally put in your head as to your next opportunity to get out. And that's exactly what causes major bubble bottoms to be situations where people are fighting each other to get out at the bottom, not near the top, but at the very bottom. And that's just all a very vicious psychological cycle that can oftentimes be compounded by these elevator type drops. As to the Fed likely reducing rates later this year, we have no idea. I think that the takeaway we probably have is that they're not going to do it until something truly breaks, and maybe we're nearer to that precipice than we were even just a few months ago, with some of the stresses starting to emerge in the banking system, and further shoes probably the drop with, for example, commercial real estate loans starting to look like and auto loans starting to look problematic. But those are exactly the kinds of situations that go hand in hand with a uninverting yield curve. Longer term rates go up, but also short term rates drop because the Fed is panicking and having to lower those rates. And it's in those panicked interest rate declines that the Fed is forced to make that usually are coincident with a big market sell-off. So whereas over the last decade, weak or lower interest rates were assigned to speculate, this time or the next phase of that rate decline may in fact just be like it has in major bubbles, tech bubble, the housing bubble, permission for folks to just run for safety all the more. I did want to quickly talk about the debt ceiling impact that Lyn talked about. She rightly puts it in context. It's not a huge thing in terms of, several $1 billion isn't a big number in the context of some of the numbers we talk about today. It is,
although she said hundreds of billions. I mean, it's
yeah, right, hundreds of billions, but still,
which still pales compared to the trillions that were done. But yes,
yeah, like if you look at it compared to the reverse repo kind of dynamic, it's still smaller than that. But the point being, it's not irrelevant. It's a relevant thing. And I know many people will dismiss, oh, well, we've been through this debt ceiling charade many times over the last decade. The difference now is we're in a totally different interest rate environment than the last episodes. So issuing debt like this Treasury will have to do to refund the general account isn't quite the non-event that it was at zero interest rates. And probably the key dilemma for the Treasury is, do we issue short-term Treasury bills to be least disruptive to, because if they issue longer-term Treasury bonds, it's essentially counteracting any quantitative tightening that they're trying to do. They're trying to or exacerbating. If they have to slow down the quantitative tightening because the system is breaking, issuing more long-term debt isn't helpful to do that. So they may be forced to issue shorter-term Treasury bills, which floods the supplies, puts the upward pressure on short-term yields, but it also is a very not necessarily prudent long-term fiscal situation to be financing debt at very short-term rates. And this kind of leads to the whole point that Lyn made, looking at, for example, EPD and the pipeline sector. Contrary to the banking situation, which banks at their heart basically borrow short. When depositors put money in a bank, it's the bank essentially borrowing short term and lending long term, whether it's a portfolio of real estate loans or business growth loans or purchasing long term Treasury or agency bonds. Those are all borrowing short, lending long. What Lyn highlighted is, perhaps we should be looking at sectors or companies that have done the opposite, where they've borrowed long, locked in historically low interest rates, and then they have a very sound, low-cost capital structure to underlie a very sound real asset that has long-term profit, income-generating potential. That's one of the key reasons why she highlighted EPD and the pipeline sector in general. There are other sectors we could look at that certainly have those kinds of characteristics, but basically a big kind of underlying shifting the cards that will probably be all sorts of regime change that will play out in a very disorderly way, but that's where tactical strategies that can glean those emerging relative strength winners and losers can be very helpful in sorting out the chaos.
Great. Well, I mean, that's a lot of the sort of, active management that she was talking about, right? Is you want to go out there and you want to find, use the term separate the wheat from the chaff, but you want to find the companies in a sector who, are capitalized like that and have the positive cash flow, whatnot. So you're not buying the sector ETF anymore and just expecting all boats to rise. You're having to do the due diligence and find these specific guys. So I assume that's a lot of what you guys spend your time there doing at New Harbor these days is really trying to find, companies that have sort of those types of advantages, versus the more sort of, sector specific approach that was taken in the past.
That's certainly on our radar. We do believe, I don't think we're quite there yet, but there is going to be an environment here where more careful selecting, and it's probably from a more settled low in markets than we're at right now. Markets are still trading very much in a macro way. After these big macro tectonic shifts, play out, we think there's going to be a real important need to kind of sift through the ashes, which we do think there will be ashes yet to come, with a finer tooth comb, which necessarily means more selective sector overweights and underweights, or avoidance altogether, but also within sectors, kind of sifting through broad sectors more discriminately for subsets of those sector companies in those sectors that are stand out on a comparative basis. Okay, but at this time, are you guys doing the due diligence to try to identify sort of the shopping list of, hey, when valuations go lower? All right, Mike, coming to you. We are now just about to enter April, which is the hated month from a tax season standpoint. Although some people like it because they're getting a tax refund check back from the government at some point. I'm just curious if people are expecting a tax refund right now. I'm sort of trying to set you up here to say, look, I imagine if you're getting a refund, probably a really good time to reach out to your financial advisor and say, look, I'm expecting to get X back. What's the best thing to do with that money in this type of market environment here? So are you having more of those types of questions with clients and leads these days?
In general, if your question is what to do with some kind of windfall, some kind of money that you come into, whether it's from a refund or something else, I think our advice is pretty consistent, to pay down debt, unless it's ridiculously low mortgage debt under 2%. I think it makes sense to pay down debt, simplify your life. It makes sense to have an adequate stash of gold and silver, 5 to 10% of your investable assets. It makes sense to have a little emergency stash of paper cash, maybe $2,000. $20 bills come in stacks of $2,000 at the bank. If you have $2,000 or $4,000, it could bring you through a couple of weeks if we had some kind of crazy shutdown of ATMs. I don't think we're really predicting a long term where you're not going to be able to get access to your cash, but certainly wouldn't call it out of the question to have some kind of inability to get cash over a shorter period of time. In terms of investments, I think that it makes sense to invest in yourself, invest in a small business if you seem to be of the entrepreneurial mindset. And we haven't really talked yet about investment ideas that that Lyn talked about or that we like, but we agree with a lot of things that she said, and these are good ideas for cash too. She talked about treasury bills, money markets for liquidity. And that's a good place to park cash while you're waiting and see what happens next in the market. As we talked about, we're at a moment of indecision. We wouldn't be surprised to see a big elevated drop in the market. So both treasury bills and money markets should yield over 4%. She talked about gold. Again, 5 to 10% of investable assets makes sense there. And energy producers. She said select energy producers. We agree. We're actually watching for a deeper drop in that sector to reestablish a position. I think the words that she said were anything that crashes, so that makes sense. That we would agree with that. We have a little downside crash, start nibbling in that sector, and long duration bonds, things like TLT make sense to nibble on too. So yeah, we're getting a lot of calls about taxes to wrap up, but a lot of them are somewhat logistical, looking for various forms and things like that. But I think those tips that I just said make sense for anybody coming into a little bit of cash.
Okay. Yeah. Great advice. So, Mike, real quick, just want to comment or get your comments on gold. We had a real run up. It has cooled off since we talked last week. I guess one question for you is, some folks might be thinking, oh, okay, well then, gold spike was really more due to just people freaking out about the banking system. And now that it looks like that's not in dire, risk of breaking tomorrow anymore. Cooler heads are prevailing, and the price of gold, is going to continue selling off from here. I mean, it's not down all that far from where it was, which was around 2000. What we're around like 1950 or so when we're talking here. What are your thoughts on that? How much of that recent strength was just fear from that one episode versus, no, this is something more secular that may be starting?
I think it's something more secular. Take a look at the big picture. Really, it's, the definition of secular is something that's longer lasting. Take a look at the big picture chart on gold, and it's going back over 12 years now to the 2011 top. We had a 40% bear market from the 2011 top to the bottom somewhere in 15 or 16, I think it was. And we climbed the right side of that base over the last couple of years. And recently, and it was based on, I guess, or it was coincident with the banking worries, we broke through 2000. And over the last couple of weeks, we've been going back and forth in a $40 range. 1960 back up to, close to 2000, back to 1960. You just mentioned that we were at 1960 today, but you may not have checked the price of gold today. Right now, it's up almost 20 at 1973 or so. So we're back up to the middle, even I would say the middle of that recent range over the last couple of weeks. And to me, it looks like it's setting up a handle and could very well break out to the upside. It's always dangerous to make predictions, and we're all very cautious about making predictions because it's easy to be wrong. And I will say that gold short term, you had a lot of call buying and bullishness, and those things are often contrary indicators that you want to be careful of. But again, if you step back and look at the big picture, the technical pattern over a long period of time has been very constructive. And I think in the medium term, there hasn't been over bullishness in this sector. Combine it with the fact that the Fed is not really going to have a lot of options left. Maybe the market is starting to realize that we're backed into the corner and some kind of accident is inevitable. I don't know. We try not to predict every nuance because we don't know for sure. But to me, I'm not afraid to make a call. It looks like we're going to break out to the upside. It looks like we're forming a handle when we break out through the top. If we break out through the top of that and solidly close above 2000, the technical projection will be another 500 points at least, up to about 2,500. So just watch and wait. It looks like it wants to break higher, so we'll see.
All right. Well, John, just in wrapping up here, so Lyn talked about being in stall speed, expecting a harder economic environment in the second half of this year. That's where I think she said that unless the Fed takes extraordinary measures in reversing policy, pretty hard to see how we avoid a recession. Jeff Gundlach there is now saying recession pretty imminent, meaning next couple of months, warning about a mineshaft decline in the markets from here. I'm not trying to spook folks, but I'm just trying to underscore that you've got a lot of very smart people that are saying, using Lyn's words, the storm clouds are gathering. Nobody has a crystal ball and knows exactly what's going to happen, but it just seems like a time where it is much more prudent to be playing defense here than playing aggressive offense, correct?
We absolutely think so, both from a big picture fundamentals and shorter term technical standpoint. And look, we know all too well because our clients are people, and all us, we're humans, our clients are humans, and humans are psychological and emotionally complicated beings. We are, and especially when it comes to money and markets, and as confusing as those are right now, they're all very confusing, even for folks like us who pour through data every day. There's some very confounding, very indecisive aspects of markets right now that require a steady hand. But I would urge folks to not to think about this as an all or nothing, or even, put your heads in the sand environment. There are things you can do to make meaningful changes without upsetting the apple cart. Getting more conservative if you're heavily into stocks and longer term bonds doesn't mean you go all to cash. Certainly it is easy to reallocate to a more conservative, easy mechanically, sometimes hard psychologically. But even if you're insistent on being heavily invested in say, a traditional 60-40 portfolio, because it's always served you well, there are ways to do that and still provide yourself protection. There are ways, for example, we can use hedging techniques to put a line in the sand to say, you know what, stay with your 60-40, but guess what? We can guarantee you that if things turn out really poorly, you're going to be no worse than X on the downside, right? And that is possible. You give something up, maybe give up some extreme upside, but the point is, it doesn't have to be this pick a side of the boat. It can be, and this is where the psychology comes in, and psychology is a real thing that we have to acknowledge as advisors. People have to acknowledge about their own situation. There is a way to balance the psychology and the likely reality of markets, and it all comes through looking and evaluating and finding that balance point. That.
All right, well said, John. And we're gonna end it there. Just wrapping up for folks here real quickly. I want to spend one quick second just inviting everybody who's watching this video to look down below the video at the subscribe button. There's a little bell icon right next to it. Just make sure if that bell icon isn't activated that you click it and activate it. And the reason why I'm saying this is I've had a number of people reach out recently who say, hey, look, I love watching your videos. I try to watch every day, but I'm not getting, or I've stopped getting my notifications from YouTube. And so the way to get those notifications is to make sure that little bell icon is activated. And even if you've been watching this channel for a long time and are thinking, yeah, I'm sure I clicked that in the past, just take a quick second to double check that it is indeed activated, because we want to make sure that these videos get to you when you want to get them fresh. All right, well, a couple quick housekeeping notes as we wrap up here. One, if you did not watch the Wealthion online conference a week ago, and you're one of the many people that have been reaching out to me to say, hey, I couldn't make it, but boy, if there's a replay video of it, I'd love to watch it. The answer is yes, there is a replay video of the entire event, all the presentations, all the Q&As. Just go to wealthion.com/conference. You can purchase the replays there. Lyn did a great job talking about all the many macro challenges that we need to keep in mind here for what may be ahead. I mentioned folks like Jeff Gundlach are issuing similar warnings. John and Mike have done a great job talking about them here. Times like these are tough times for professionals to navigate. They're exceptionally tough times for regular investors, people that have real lives that occupy their attention during the day, and they just don't have the time or the expertise to build a portfolio strategy around all this. But then to be working on that kind of active management, right? Sort of reacting in real time to the developments as they're going on. So that's why we highly recommend people work with a professional financial advisor who can do that for them. And if you've got one who's doing that, great, stick with them. Incredibly valuable and pretty rare, to be honest. If you don't have one, or you'd like a second opinion of one who does, perhaps even John and Mike and their team there at New Harbor, schedule a free personal consultation with one of the advisors that Wealthion endorses. Just go to wealthion.com. Fill out the short form there. Only takes a couple of seconds to schedule one of those consultations. Doesn't cost you anything. No commitment to work with these guys. Just a public service they offer to help people be more prudently positioned for what may be coming ahead. And with that, folks, John, I'll give you the last word here. Mike, I'll give you the last word here on any parting bits of advice you'd like people to keep in mind as they leave this video to go off and navigate these highly uncertain markets we're dealing with.
Oh boy, thanks for that opportunity, Adam. Really nothing in particular, nothing fancy, just reduce risk if you haven't already, and be patient. Don't get frozen, and treasury bills and or money markets that own treasury bills are paying over 4%. Don't worry about inflation short term. Just get your money safe, sit back, enjoy the summer. Just enjoy the summer and wait and see what happens. That's it.
All right. Comforting words. All right, folks. So if you have enjoyed this conversation with Lyn, would like to see her back on the program soon, as well as other great experts like her, please do me a favor, support this channel by hitting the like button and then clicking on the red subscribe button below if you haven't already. And absolutely, yes, click that little bell icon right next to it as well. John and Mike, guys, thanks for joining me for yet another week. Great conversation this week. Whatever the markets do from here, we'll be breaking it down for everybody next week and trying to help them make sense of what's going on and what's most likely to happen next. Thanks for joining me, guys. Everybody else, thanks so much for watching.
Thank you, Adam.
See you next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.